The task force will now come to order. Without objection, the chair is authorized to declare a recess of the task force at any time. And without objection, members of the full committee not on this task force are authorized to participate in today's hearing. This hearing is entitled Keeping Up with the Codes Using AI for Effective RegTech. I now recognize myself for 5 minutes to give an opening statement. Thank you, everyone, for joining us today and for what should be a very interesting hearing of the task force. Today, we're looking to explore how different financial regulators have been leveraging AI technology to improve their regulatory and supervisory efforts. The use of AI and machine learning by financial institutions, known as RegTech, as well as the use of AI and ML by financial regulators, known as SupTech, are two areas that are rapidly garnering regulatory focus. To give our audience some idea of what we're talking about, imagine that a regulator comes up with a simple rules-based method for automatically generating, say, suspicious activity reports. Such a system will soon be flooded with false positives, that is, activities that appear suspicious but are in fact not. So an experienced human regulator will then be assigned to sort through these to determine which are spurious and which are truly suspicious activities. And this will rapidly generate what's called a tag data set that can be used by machine learning algorithms to approximately replicate the human's complex judgment at scale and at low cost, which all sounds great until you encounter all of the classic problems with AI and machine learning. That is, if the human inspector was racist, the machine learning algorithm will be. And sophisticated bad actors will have the ability to pollute the data set with thousands of non-suspicious activities so as to trick the ML algorithm to give a pass to a small number of serious violations. This is a complex space, and taken together in the financial services space, RegTech and SupTech may help financial institutions and government regulators monitor transactions, evaluate risk, detect noncompliance, identify illicit finance, and implement regulatory changes at a rate never seen before. The AI community anticipates that the use of RegTech and SupTech will grow significantly in the coming years, and with the global RegTech market projecting it to reach over $55 billion by 2025. This rapid growth exemplifies why it's so important that we get these technologies right, that we need to make sure that we leverage these powerful tools in the right way. Just as we work to ensure that private industries utilize AI and ML in a responsible manner, we need to be sure that our government regulators and entities embrace such technology to improve oversight and strengthen supervision of the financial services industry. Financial institutions' risk management and compliance operations rely heavily on synthesizing large data sets and detecting both trends and uncharacteristic activity. A large portion of this calculus depends on the ability of these firms and regulators to successfully predict whether wrongdoing or other risk may occur in the future. With this great predictive ability, AI must remain accountable to broad regulatory schemes. Those employing AI in their business processes or regulatory efforts cannot avoid responsibility if unintended or unwanted results occur. As with any AI, the use and implementation must be carefully monitored and evaluated, in the end by a natural person in some capacity. Similarly, regulators and inspectors must be able to look under the hood of business operations utilizing AI, especially in sensitive and impactful industries such as the financial services space. These algorithms and programs must be accountable, explainable, and adjustable. So I'm glad we're gathered here to discuss such an important topic and to better ascertain how we can promote responsible innovation and adoption amongst both financial services participants and its regulators. And with that, I'd like to recognize the task force ranking member, my friend from Ohio, Mr. Gonzalez, for 5 minutes.
Thank you, Mr. Foster, and thank you, as always, for your leadership on this committee. Always a pleasure to work together, and I share your interest and excitement for the possibilities of increased use of emerging technologies in our regulatory system. Technology has transformed the way that Americans interact with financial institutions for the better. Today, Americans can access banking services, buy and sell stock, and get approved for a mortgage faster and cheaper than ever before without ever having to step foot into a local bank or credit union, should they choose. In our work on this committee, we should be doing more to promote the adoption of new technologies to further optimize operations and open finance to more Americans. The expanded use of AI and machine learning will help financial institutions use data more efficiently and reach more Americans. That brings us to today's hearing. In one of my first hearings as a member of this committee, I advocated for our financial regulators to explore the applications of emerging technologies like AI and machine learning. As financial institutions have made great strides in innovation, so too should our financial regulators. To me, the benefits are twofold. First, it will help decrease regulatory costs on financial institutions, particularly our smallest financial institutions, which are often the bedrock of local communities. A 2015 Federal Reserve Bank of St. Louis study found that compliance costs are disproportionately high for small banks at an estimated cost of 22% of net income. Globally, the costs of compliance for banks are estimated to be at least $100 billion. This prevents institutions from being able to invest those dollars into further innovations, but most importantly, makes financial products more expensive for everyday customers. Our goal should be to reduce these regulatory costs and give institutions, especially smaller financial institutions, the flexibility to deploy their capital more efficiently. It is important to note that decreasing regulatory costs does not necessarily mean decreased regulation. This leads me to my second point. Increased use and deployment of RegTech and SupTech will lead to more effective and efficient regulations. As the financial institutions rapidly increase their use of AI and machine learning, we run the risk of traditional financial regulatory systems being vulnerable to failure. In my view, the use of RegTech can play a critical role in enhancing consumer protection, containing systemic risk, reducing financial crimes, and creating greater regulatory feedback between financial institutions and federal agencies. In today's hearing, I'm excited to hear from our witnesses on the current utilization of AI and machine learning by private industry and federal agencies and the barriers facing regulators, including whether agencies have the technical staff, resources, and sufficient congressional authority. We must also confront the potential difficulties of the greater use of RegTech, including bias in algorithms, challenges in implementation, and the protection of Americans' personally identifiable information. Again, I want to thank Mr. Foster for convening today's hearing. Look forward to hearing from our witnesses, and I yield back.
Thank you. And today we welcome the testimony of our distinguished witnesses. First, we have Kevin Greenfield, the Deputy Comptroller for Operational Risk Policy at the Office of the Comptroller of the Currency. Next, we have Melanie Hall, who's the Commissioner of the Montana Division of Banking and Financial Institutions, as well as the Chair of the Board of Directors of the Conference of State Bank Supervisors. Next, we have Kelly Lay, who is the Director of the Office of Examination and Insurance of the National Credit Union Administration. And finally, we have Jessica Rusu, who is the Chief Data, Information, and Intelligence Officer of the Financial Conduct Authority. Witnesses are reminded that their oral testimony will be limited to 5 minutes. You should be able to see a timer on your screen that will indicate how much time you have left, and a chime will go off at the end of your time. I'd ask that you be mindful of the timer and quickly wrap up your testimony if you hear the chime, so that we can be respectful of both witnesses and committee members' time. Without objection, your entire written statement will be made part of the record. Mr. Greenfield, you are now recognized for 5 minutes to give an oral presentation of your testimony.
Chairman Foster, Ranking Member Gonzalez, and members of the task force, thank you for the opportunity to appear today and discuss artificial intelligence tools used by national banks, federal savings associations, and federal branches and agencies of foreign banks supervised by the Office of the Comptroller of the Currency. I appreciate this invitation to discuss the opportunities, benefits, and challenges artificial intelligence, or more commonly AI, presents for banks and our approach to supervising those activities. I serve as the OCC's Deputy Comptroller for Operational Risk Policy, and am responsible for overseeing the development of policy and examination procedures addressing bank operational risk, which includes understanding and monitoring risks of AI. I also represent the OCC in international forums, such as the Basel Committee on Bank Supervision's Financial Technology Group, which coordinates the sharing of regulatory practices on tech issues, including those related to the use of AI. Technological changes and rapidly evolving consumer preferences are reshaping the financial services industry, creating new opportunities to provide consumers, businesses, and communities with more access to financial products and services. The OCC promotes responsible innovation in the banking industry to expand access to credit, capital, improve operations, and support full and fair participation in the American banking system. Over the years, we have adapted our supervisory approach to address the increase in banks' use of technological innovations such as AI. Today, banks can use AI tools to strengthen their safety and soundness, enhance consumer protections, and increase fair access to products and services. AI can be used to enhance the customer experience, such as assisting with online account openings and product selection. AI can also be used to support more efficient credit underwriting and other banking operations. Used in appropriate ways, these approaches have the potential to promote greater access to banking services by underserved communities. Use of advanced analytical tools is not new, and banks have been employing mathematical models to support operations for some time. However, banks are now introducing AI tools to support even more complex operations and increased automation. While we have seen many large banks develop these tools internally, AI tools and services are becoming more widely available as third-party firms are increasingly offering AI products and services to banks of all sizes. While AI tools can present benefits, we must also be mindful of the risks if banks' use of AI is not properly managed and controlled. Potential adverse outcomes caused by poorly designed models, faulty data, inadequate testing, or limited human oversight. Banks need effective risk management and controls for model validation and explainability, data management, privacy, and security, regardless of whether a bank develops AI tools internally or purchases through a third party. The OCC follows a risk-based supervision model focused on safe, sound, and fair banking practices, as well as focused on assessing compliance with laws and regulations. OCC examiners have significant experience in supervising banks' use of sophisticated mathematical models and tools. This includes evaluating fair lending concerns and other consumer protection issues, such as unfair or deceptive acts or practices. The OCC expects banks to monitor for and identify outcomes that could create unwarranted risks or adversely impact the fair treatment of customers. If we identify any concerns, risks, or deficiencies during our examinations, the OCC has a range of tools available and will take supervisory or enforcement action as appropriate. But just as banks are increasingly using sophisticated technologies and tools to enhance bank capabilities, the OCC is similarly engaged in assessing how innovative technologies can strengthen our supervisory processes. The OCC employs a number of analytical and technology tools to support bank supervision, and work is underway to materially upgrade our core supervision systems to further enhance this ability to monitor risks in the banking system. Moreover, the OCC is considering the use of AI tools as part of this effort. I want to thank the task force for its leadership on this important issue and for inviting the OCC to testify today. I look forward to answering your questions.
Thank you, Mr. Greenfield. And Ms. Hall, you are now recognized for 5 minutes to give an oral presentation of your testimony.
Good morning, Chairman Foster, Ranking Member Gonzalez, and members of the task force. Thank you for holding this hearing. My name is Melanie Hall, and I am the Commissioner of Montana's Division of Banking and Financial Institutions and Chair of the Conference of State Bank Supervisors Board of Directors. It is my pleasure to testify today on behalf of CSBS on how the state system uses technology today and how we see it shaping the future through network supervision, a federated regulatory approach to further evolve and streamline the state system. First, I'd like to address how states are using technology platforms as well as data analytics to enhance state supervision today. CSBS operates a regulatory licensing platform called the Nationwide Multi-State Licensing System, or NMLS, on behalf of state regulators. NMLS became part of the SAFE Act in 2008, but got its start in the early days of the mortgage crisis as state regulators recognized a need to stop bad actors from leaving one state just to move to another. Today, nearly 640,000 companies and individuals use NMLS annually to manage their business licensing and registration. These companies and individuals span the mortgage, consumer finance, debt, and money service business industries, with the mortgage industry accounting for more than 80% of NMLS use. The NMLS is also used to register mortgage loan originators who work at banks and credit unions. This RegTech has helped state regulators become more efficient and risk-focused. NMLS data and information is used to identify trends in licensing and supervisory activities. In particular, the data has given state regulators a deeper perspective into the mortgage industry and helped to identify applications and companies that may require more scrutiny. NMLS data further helps state regulators analyze nationwide trends and identify risks through quarterly reports on both the mortgage and MSB industries. CSBS is also in the early stages of developing a call report for consumer finance. Building on the success of NMLS, in 2020, the states launched a new technology platform called the State Examination System. SES is the first nationwide system to bring regulators and companies into the same technology space for examinations. State agencies can conduct exams and investigations, process consumer complaints, and do other supervision work through this secure platform and share that information with industry and other states. SES provides uniformity and efficiency, reducing regulatory burden for multi-state companies. In addition to these two important technology platforms, CSBS has a dedicated data analytics team that works with state regulators to find new ways to anticipate and mitigate risk. Some of the areas that state regulators are exploring include using a technology tool to understand emerging trends from examiners in the field, using predictive modeling as an early detection tool for bank risk, and piloting a predictive analytics program, and understanding how AI could be used to review loan files for consumer compliance, and more. Network supervision will evolve the state system to one where communication occurs in real time, knowledge and expertise flows across the states, and regulation becomes streamlined. Last year, the CSBS board identified network supervision priorities to advance this wide-ranging initiative. The priorities lay the foundation for future collaboration, and further work started under Vision 2020 to streamline the licensing and supervision of money service businesses. Network supervision requires timely and robust data and information sharing between state and federal agencies. In addition to developing platforms that support this objective, CSBS is identifying and modernizing the necessary legal underpinnings to enable greater data sharing. The state system has information sharing agreements with numerous federal agencies, and we are pursuing and would appreciate your support of more of these arrangements. States are working toward a future where technology platforms and data analytics allow 54 state financial agencies to operate as one seamless supervisory network. This networked approach will transform financial regulation, giving state regulators even greater ability to identify and understand local risks before they threaten consumers and the financial system at a national level. As noted in greater detail in my written testimony, the states are committed to implementing technology solutions and collaborating in new ways to improve oversight and enhance consumer protections while reducing regulatory burden. Thank you for the opportunity to testify today. I look forward to answering your questions.
Thank you, Ms. Hall. And Ms. Lay, you are now recognized for 5 minutes to give an oral presentation of your testimony.
Chairman Foster, Ranking Member Gonzalez, and members of the Task Force on Artificial Intelligence, thank you for conducting this hearing on the effective use of AI and RegTech and the opportunity to testify before you today. My name is Kelly Lay, and I am the Director of the Office of Examination and Insurance at the National Credit Union Administration. I started my career with the Ncua as an examiner in the field and have held various positions throughout the agency. Most recently, I was the Ncua's Director of the Office of Business Innovation and led the development and implementation of the agency's new examination platform, the Modern Examination and Risk Identification Tool, also known as MERIT. In my testimony today, I will first focus on the agency's examination modernization efforts. Second, I will highlight research the Ncua has conducted in the realm of AI and RegTech and the Ncua's challenges to incorporate AI and RegTech technologies in the credit union industry. Third, I will discuss last year's request for information on the institutional use of AI. I will conclude with a legislative request for the Ncua to receive third-party vendor authority. In 2015, the Ncua formed the Enterprise Solution Modernization Program to help Ncua staff regulate and supervise credit unions more efficiently. The program aims to modernize the Ncua's technology solutions to create an integrated examination and data environment and facilitate a safe and sound credit union system. As an initial step, the Ncua prioritized replacement of the legacy examination application, also known as ARIES, which was over 25 years old. After several pilot phases, the Ncua rolled out Merit, including enhanced integrated analytics utilizing a business intelligence tool, and our new secure central user interface called Ncua Connect to Ncua, state supervisory authorities, and credit unions in the second half of 2021. Currently, the Ncua has focused on helping users through this significant transition while deploying system enhancements. In 2017, the Ncua board also approved virtual examination exploration and research funding. Currently, the virtual examination project is in the research and discovery phase. The agency's goal is to transition within the next 5 to 10 years the examination and supervision program into a predominantly virtual one for credit unions that are compatible with this approach. The Ncua is in the testing phase of deploying machine learning model to perform data validation more efficiently with quarterly call reports and profile submissions. Deployment of this new technique is expected to occur in the next 4 quarters and should result in more reliable and consistent call report filing across the industry. The Ncua recognizes the importance and benefits of technological changes and has incorporated organizational change management strategies into our initiatives. However, there are challenges. In addition to dedicated resources for development and testing, expanding the Ncua's use of RegTech and AI would require the agency to train examiners and credit unions as applicable and revise our examination policies and procedures. In addition, while the Ncua supports and encourages innovation and the growth of the industry, we also must protect the interest of credit union members in terms of privacy and security and not compromise the industry's safety and soundness. Furthermore, most federally insured credit unions have less than $100 million in assets. These small credit unions fulfill a vital role in their communities, but are usually short-staffed and lack the expertise and resources necessary to keep abreast of changing technology. Generally, these smaller institutions neither have the economies of scale nor the expertise necessary for sophisticated analytics. Last year, the Ncua joined the OCC, FDIC, Federal Reserve, and CFPB in a request for information on the institutional use of AI and related challenges. We collectively received responses from financial institutions, vendors, industry trade groups, academic communities, and consumer advocacy organizations. In total, we only received 32 comments. Of those, only 4 were from the credit union industry. Finally, any examination of technology and the Ncua is incomplete without discussing the significant challenges the agency has confronted since the 2002 expiration of its third-party vendor authority. While there are many advantages for credit unions to use these service providers, the continued transfer of operations to credit union service organizations and other third-party vendors diminishes the ability of the Ncua to accurately assess all the risks present in the credit union system and determine if current credit union service organization or third-party vendor risk mitigation strategies are adequate. I would like to thank Chair Foster for introducing the Strengthening Cybersecurity for the Financial Sector Act to give the Ncua third-party vendor examination authority. I urge the members of this task force to review this legislation and consider adding their support to close this growing regulatory blind spot the Ncua continues to confront. This concludes my statement. I look forward to your questions.
Thank you. And Ms. Russo is now recognized for 5 minutes.
Good morning, Chairman Foster, Ranking Member Gonzalez, and members of the task force. Thank you for the invitation to appear virtually before committee members today. I am currently serving as the Chief Data Information and Intelligence Officer at the Financial Conduct Authority. For the committee's background, the FCA is the conduct regulator for approximately 51,000 financial services firms in the UK. The FCA is responsible for ensuring relevant markets function well, as well as operational objectives to protect consumers and promote effective competition. In my role at the FCA, I am focused on building digital supervision technologies and leveraging data science and intelligence capabilities. As stated in our 2022 business plan, we believe that an increasingly data-driven industry should have a regulator. Therefore, the use of AI, both by industry as RegTech and for the purposes of regulatory supervision or subtech, is an important area of focus for us. The Data Technology and Innovation Division that I lead engages with firms, subject matter experts, and fellow regulators to drive positive transformation in how we regulate. The FCA's innovation services include tech sprints, digital and regulatory sandbox activities, innovation pathways, as well as our scale box and early oversight for new firms. Our tech sprints are events where we convene industry experts to develop proofs of concept to address specific challenges such as AML and financial crime. The regulatory sandbox allows businesses to test new propositions in the live market with real customers and regulatory oversight, whereas the digital sandbox enables proofs of concept to be developed using complex synthetic datasets. Recent digital sandbox participants have focused on ESG data and fraud prevention. Turning to the focus of today's hearing, we believe that new technologies can bring positive benefits to consumers and markets. As part of our work on AI, we want to facilitate a debate on the risks and ethical questions associated with its use. The FCA is actively exploring how we can use AI techniques as well for supervisory and enforcement purposes, including leveraging advanced analytics techniques in our intelligence work, which seeks to extract insights from FCA data to increase the speed and accuracy of decision-making, which we will further embed with triaging and intervention models. Externally, we have partnered with the Bank of England on the development of the AI Public-Private Forum, established in October of 2020 to share information and understand the practical challenges of using AI in financial services, as well as the barriers to deployment and potential risks. The FCA also collaborated with the Alan Turing Institute on a year-long project which explored the practical application of a high-level framework for responsible AI. Currently, we are working with the Bank of England to issue a joint public discussion paper on AI, supported by new research that will help us to deepen our understanding of how AI is changing UK financial markets. In terms of the high-level outcomes from the work thus far, we see that existing model risk management frameworks reinforce that organizations must take responsibility for algorithmic decision-making, regardless of the technology used. And in terms of risk management, we see that AI forums are advocating that human-in-the-loop processes exist. Data is a key building block of responsible AI. We require firms to ensure they demonstrate robust controls, consider data quality, including provenance and recency of data utilized, as well as cyber and data security when implementing new technologies. Governance and accountability are therefore core to the way the FCA thinks about AI. The wider FCA and I would be happy to remain engaged with the committee and US regulators to continue this discussion. Thank you very much.
Thank you, Ms. Rusu, and I want to thank you also for your excellent written testimony, including many interesting links to all the great work, like things like tech sprints that you're doing, that you're involved in, that unfortunately kept me awake way too late last night. Now, to our members, I'd like to say that we anticipate a second round of questions should be possible, so you can keep that in mind. I will now recognize myself for 5 minutes. I'd like to start by quickly responding to Ms. Lay's important points regarding third-party vendors. In FSOC's annual reports for 2015, 16, 17, 18, 19, 20, and again in 2021, which happens to span 2 Democratic and 1 Republican administrations, the Council has highlighted the fact that we have a regulatory blind spot with respect to the oversight of third-party vendors of Ncua and FHFA's regulated entities. Federal banking regulators are able to examine and oversee banks' third-party vendors, which can help ensure those third parties, especially technology firms that banks may utilize, so that they do not pose a cybersecurity vulnerability or other risk to the safety and soundness of the banking system. The Examination Parity Act gave Ncua and FHFA this very authority from 1991 till it was sunsetted in December 2001. And since then, both agencies, the GAO, FSOC themselves, have repeatedly and explicitly requested that this authority be reinstated. And I've introduced the Strengthening Cybersecurity for the Financial Sector Act to address these regulatory gaps and at the NCUA and FUFA. Ms. Lay, the NCUA report concludes that the NCUA's lack of authority over third-party vendors is a growing regulatory blind spot and has a potential to trigger cascading consequences throughout the credit union industry and the financial services sector that may result in significant losses to the NCUA. Can you elaborate a little bit on this issue?
Yes, thank you for the question, Chairman Foster. Currently, the NCUA does not have examination authority over third-party vendors, and so we are unable to implement corrective action on any third-party vendor if we find issues. We do go into third-party vendors, credit union service organizations voluntarily, and can provide corrective or recommendations for corrective action. However, we have had instances where those third-party vendors, credit union service organizations, do not respond to that corrective action that we put in place. We have a number of small credit unions. Over 2/3 of our credit unions are less than $100 million in assets, and they really would rely on our ability to provide, help them with their due diligence of third-party vendors if we could have this third-party vendor authority.
Thank you, and I'll probably get back to this issue in the follow-on questions. Ms. Hall and Ms. Lay, how do you handle the whole issue of explainability? And well, actually, all of our witnesses. You know, during the financial crisis, I talked to some gentlemen who have been running some of the banks that tragically failed and asked them what it was like as the regulators came in and closed their bank. And they at least knew the formulas and the tests that they were failing. But if someone comes in to your bank or credit union and says, I'm sorry, our neural network predicts that you're going to fail, you know, how do you explain this? And how do you handle that, the whole problem of explainability, you know, at all levels? Ms. Hall, do you want to take a swing at that?
Chairman Foster, thank you for the question. I think that explainability and AI is something that can be challenging, particularly for community financial institutions. And ultimately, over time, we just have to continue to prove out what has been established by the theories. So, for instance, in Montana, we were one of a few states that did not have any bank failures during the financial crisis, despite some of those AI predictive technologies showing that we would have bank failures. And so I think that we have to focus on the data inputs in order to ensure that those inputs are actually reflective of expected outcomes. And so I think that requires constant change. And I think that's where AI can really help financial regulators if there is an effective feedback loop. And I think that in a lot of ways, the regulatory agencies have struggled with that feedback loop in plugging back in what the ultimate outcome was in order to determine whether the models themselves worked.
Thank you. And my time is essentially expired, so I'll recognize the ranking member for 5 minutes.
Thank you, Chairman Foster, and thank you again to our panel for being here and for your testimonies. As I mentioned in my opening statement, I believe we need to be doing more to encourage the use of AI for regulatory purposes, both by the financial institutions themselves, but also within our regulatory agencies. Ms. Lay, I'm going to start my questioning with you. In your testimony, you discussed that the NCUA is investigating the use of natural language processing, which transforms unstructured data into structured data, increasing the uses and applicability of said data. What are the barriers facing the NCUA in implementing this technology at present?
Thank you for the question. I believe that one of the barriers that we face is that AI is just very expensive, and those costs would fall to our credit unions as they pay for our budget. So technology, AI is very expensive. I think another barrier is just the fact that many of our credit unions are less than 100 million in assets, and so they also don't have the sophistication, sometimes, and the level of staff to be able to adopt these technologies. So that would also be a barrier.
Okay. What, if anything, are you all able to do to help mitigate those barriers? Like the cost one makes sense to me for sure, but at the same time, if all the bigger players are adopting the use of some of these technologies, we obviously don't want our credit unions to fall behind on that front. So what, if anything, are you all able to do to help mitigate that cost issue?
So one of the things that I think that we could do is if the agency were granted a third-party vendor authority, that would allow us to conduct examinations of any third-party vendors that credit unions would be using to implement artificial intelligence technologies. And so I think that would assist our credit unions in being able to have the ability to see our reports of examination of those third-party vendors and assist them in their due diligence process.
Got it. So help them on the front end in terms of the diligence side. That makes a lot of sense. Ms. Rusu, I'm going to switch to you. So on this committee, we often talk about the concerns of algorithmic bias and the potential impact it could have on decision-making processes. How do you all handle that in the UK? I'm just curious, because we talk about it a lot, and I'd just be curious for more of an international perspective on that issue specifically.
Sure. Thank you for the question, Ranking Member Gonzalez. In the UK, I would clarify that there is a distinction between discrimination and bias. So in the concept of algorithmic bias, we think about whether or not groups could be disproportionately impacted, primarily through bias that would exist in the underlying data. And I think it's important, and as you referenced in your earlier opening remarks, in terms of general model risk management, you have to control both the inputs that go into the model as well as the outputs. And so that's how we're thinking about bias in algorithms. And we understand the complexity and the challenges in understanding how bias in algorithms can lead to unfair outcomes that might inadvertently privilege one group of users over another.
Thank you. And Mr. Greenfield, picking up on that line of questioning, how are regulators working with private industry to prevent the use of biases in their models?
Through our ongoing supervision process with both financial institutions, as well as our work with many of the bank service providers, we're very focused on banks having effective risk management and governance in place for the use of these models, which will include controls for the model development, validation of the model, testing of the model, both initially when in production, but what's also very important is continued oversight of the model over time as assumptions change, the data and data quality can change over time, and very much look at how that's being monitored, and those outcomes are very, very closely monitored. And engaging in those discussions with financial institutions as well as the model developers, and then putting out guidance such as the model risk management guidance that the banking agencies have been using for some time now.
Thank you, and I yield back.
Thank you. And the gentlewoman from North Carolina, Ms. Adams, is now recognized for 5 minutes.
Thank you very much, Mr. Chairman, and thank you to our witnesses, to our ranking member as well, and of course, Congresswoman. Let me ask, well, first of all, bank secrecy, that the BSA regulatory failures and penalties over the last 10 years have been due to a failure to detect and report suspicious activity, among other violations. I hear regularly that financial institutions, especially smaller entities, are both accountable for and at the mercy of the RegTech service providers. So, Mr. Greenfield, Ms. Lay, and Ms. Hall, in that order. For BSA AML compliance, if not in other areas, are your agency's oversight activities appropriately balanced? Mr. Greenfield first.
Yes, I believe so. We're very focused on how banks are setting up their risk management and compliance frameworks to manage the risk. And as mentioned earlier, we take a very risk-based approach. So depending on the size and complexity of the institution, and the services it offers, that level of oversight and that level of risk management system would be commensurate with the activities of the bank. We do engage in...
Go ahead, finish.
Okay, we do engage in our ongoing communications, and we do encourage, especially smaller community banks, to work together to be able to leverage services more effectively, more efficiently, and more economically, and also do focus on the service providers to make sure that they're providing that level of service to those banks.
Thank you. So, Ms. Lay, what would you say about that?
Yes, thank you for that question. BSA and AML for our smaller credit unions is definitely burdensome and something that we know that they absolutely need to follow. But for our smaller credit unions that only have one, maybe two staff persons, they will need to, or bringing in artificial intelligence to help them with that compliance could certainly be a benefit. I think the agency.
Okay. Well, good. Thank you. Ms. Hall. How would you respond, Ms. Hall?
Thank you so much for the question. I will just say, first of all, state regulators really appreciated Congress enacting BSA reform that supports greater use of technologies. State regulators supervise a large percentage of smaller banks and smaller credit unions, and BSA AML compliance certainly is a tremendous cost to them, often without a solid feedback loop to let them know how that information is being used. AI is BSA AML is a perfect example of where AI could be really helpful because AI is really good at anomaly detection. However, what we really need is a strong feedback loop with law enforcement and the federal agencies in order to improve that AI and make it more accessible to smaller institutions in order to help with the costs of BSA compliance.
Okay, so let me ask briefly for each of you, should RegTech firms themselves regulated or engaged in your financial institution oversight in a different manner? Greenfield?
And say, if I understand the question, so that should RegTech firms be engaged with banks in a different manner or oversight of? We believe RegTech firms should be in communication with their client base, which would be the financial institutions, and meeting their needs to ensure compliance in an economical and efficient manner.
Okay,
We have conversations
just a few more seconds. So, Ms. Lay and Ms. Hall, I want to at least get a response, a brief from each of you as well.
We are in the early stages of looking at AI for RegTech. We do believe that we would need to consult and speak with many of our credit unions in the industry before implementing.
Ms. Hall?
Representative, state regulators would urge passage of HR 2270, which would allow greater coordination and information sharing between the federal and state regulators on third-party service provider exams. That bill is working its way through Congress, and it would allow, a lot of states have their own laws that say they can regulate these third-party service providers, but the federal agencies are unsure of how much they can coordinate and share information with us. And so that bill would really go a long way to helping to ensure that there's good coordination and information sharing.
Thank you, ma'am. I'm out of time. Mr. Chair, I'll yield back.
Thank you. And the gentleman from Georgia, Mr. Loudermilk, is now recognized for 5 minutes.
Oh, thank you, Mr. Chair, and thank everyone on the panel for being here. Some of my colleagues and even other observers have raised concerns recently that artificial intelligence and machine learning can exacerbate bias. However, I believe that if used properly, artificial intelligence and machine learning can actually be used to reduce unfair or irrelevant bias. Some of the essential components for obtaining unbiased results are through record keeping of what goes into algorithms, robust testing, and strong risk management. Ms. Hall, are there potential risks with using artificial intelligence exclusive to AI? Are they inherent to any model risk management framework?
Congressman, I would believe that they are, that bias is always a part of any kind of model and predictive modeling. I do think that there is the capacity for machine learning, hopefully, to eliminate that bias faster than we have been able to eliminate it in humans themselves. That if there are appropriate feedback loops, if there is appropriate information and data gathering there, I do believe that machine learning could help to eliminate that bias readily, as long as there are appropriate feedback loops.
So in reality, bias exists everywhere. It's not just in the artificial intelligence, but with proper testing and checking and data analysis, you believe we can eliminate, for the most part, unfair bias.
Congressman, not an AI or machine learning expert myself, but I certainly would believe that it's faster than humans, as we have proven out as humans to not be all that fast in our bias elimination. I would think that machine learning with, evidence showing the actual outcomes could potentially be much quicker in eliminating that bias. And I don't think that that there is a way to eliminate necessarily that bias on the very front end, but hopefully the learning process of machines is faster than our own.
Okay. And I mean, I would submit that there is inherent bias in human opinion and decisions, and you can eliminate that through the machine if you have the proper data. Ms. Greenfield, can you describe how the existing bank regulatory structure already accounts for model risks associated with AI? Mr. Greenfield?
Yes. I was going to say, so we do, yes, we have extensive experience and history with model risk management. We have supervisory guidance that was jointly put out by the banking agencies that provides expectations for banks as it relates to risk management, governance, testing and validation, control and oversight of these models. We have examination programs that focus on this, as well as we take an integrated supervision approach that when assessing AI or model risk management within financial institutions, we will bring in PhD economists, subject matter or topic experts, whether it be on fair lending, whether it be on credit underwriting, or whatever the activity being conducted, as well as technology experts that work together in order to identify potential risks or concerns with model risk management and communicate that to the financial institution with expectations for corrective action.
So when you do bring that to the attention of the financial services business or organization, are they examined and supervised in a way that would require them to address these risks before they go forward? In other words,
yes.
Does the government oversee how they address those?
Yes, we have a number of supervisory tools available to us, ranging from matters requiring attention and reports of examination to enforcement actions. But when we identify deficiencies, we will require corrective action and follow up and follow through to ensure it has been done effectively.
All right, thank you. Ms. Lay, I've been concerned about the government's resistance to adopt certain technology. In fact, the FDIC CIO resignation a few months ago was alarming because he addressed the resist to change. If financial regulatory agencies are technologically stagnant, doesn't that make it difficult to keep up with the changing nature of the companies they regulate?
We agree the ability, for Ncua and our credit unions to adapt to new financial technologies is very important. The Ncua does not want to hamper innovation in our agency or in our credit union industry. One of the things that I've testified here today is that many of our credit unions are small, less than 100 million in assets, and will need to rely on artificial intelligence or rely on third-party vendors to get into the artificial intelligence space. So for the agency to have third-party vendor authority to help those credit unions with their due diligence of those companies would be very helpful for the agency. I will just add that we have been going through a technology modernization at the Ncua for the past 5 years, and our Ncua board and executive leadership have been very supportive of that modernization.
All right, thank you. I yield back.
Thank you. And the gentleman from Massachusetts, Mr. Auchincloss, who is also the vice chair of the full committee, is now recognized for 5 minutes.
Thank you, Chairman, for organizing this important hearing. My question is for Mr. Greenfield and for Ms. Rusu, but other witnesses are welcome to jump in too. This last 10 days, we have seen that algorithmic stablecoins are not so stable. And it's clear that we are going to need both updated auditing and disclosure regulation from Congress for the stablecoin industry, but also for regulators to be able to track the redeemability of stablecoins if these continue to be an important part of the modern economy. Mr. Greenfield, while it's not quite AI, obviously, it is deep tech. What tools does the OCC have at its disposal to be monitoring the redeemability and liquidity of algorithmic stablecoins? And Ms. Rusu, knowing that the United Kingdom has been really at the forefront of much of this legislation in the crypto space, what advice might you offer us here in the United States on this front?
Sure. I'll start off just stating that I am not aware of any banks directly dealing with algorithmic stablecoins. However, as you note, it is very much a key topic, and the OCC is very focused on the development and use of stablecoins throughout the financial sector. We do have a number of policy initiatives and research underway looking at use of crypto assets throughout the financial sector and within the national banking system. Our Office of Innovation is very focused on this, and we are currently engaged in what we have referred to as crypto policy sprints with the FDIC and Federal Reserve colleagues.
Mr. Greenfield, if the OCC were vested by Congress with the authority and the mandate to supervise stablecoins, both algorithmic and and fiat backed, is it within the capabilities of the OCC to do that?
We have put out recommendations on a framework for stablecoins as part of the presidential working group that was published last year. It is something that we are very focused on developing, and Acting Comptroller Sue has spoken extensively on stablecoins. So it is something that we are very focused on and looking at what a potential regulatory framework would look like.
And you think OCC has an important part to play in that?
Yes.
Ms. Rusu?
Yes, so thank you for the question. As you know, we do not yet regulate crypto assets except through the anti-money laundering regulation, but we are following up on this area. And this week I held the first crypto sprint, policy sprint this week, and we considered 3 problem statements around crypto asset disclosures to investors to address the inadequacy of information shared. We looked at centralized versus decentralized regulation approaches and gaps in the existing regulatory framework for custodians and the complexities of ownership around crypto assets. And we expect to share the findings from the policy sprint later this summer. We've also started a project using a web scraper to identify websites that are promoting crypto assets and using text analysis to identify risk indicators on the sites. So just recognizing that it's a complex area for regulation, and the algorithms involved share all of the same complexities that AI algorithms share as well.
Ms.
And
Rusu,
recognize
Ms. Rusu,
the interests of.
Is it the opinion of the mass of UK financial regulators that algorithmic stablecoins have a place at all in a stablecoin ecosystem, or are you coalescing behind only fiat-backed stablecoins?
I don't think we've reached a decision yet on that point, but we're certainly looking at all of the different categories of crypto assets.
And Mr. Greenfield, do you have an opinion on that question?
To the point of our focus on stablecoins, we've been very focused on understanding the transparency in reserves, redeemability issues, as you've noted, as well as looking at the importance of having liquid assets in reserve as part of a stablecoin framework.
But do you think that there is a role for algorithmic alongside fiat-backed stablecoins, or is that a to-be-determined question?
I believe that's to be determined. That's something as we look at the development.
I yield back my time, Mr. Chairman.
Thank you. And now we will resume our second and final round of questions here. Ms. Rusu, one of the most interesting links in your written testimony was dealing with efforts towards what's called federated learning. This addresses a problem that occurs really at all levels of financial regulation, where regulators have access to the detailed information on individual entities that they regulate. They would like to share that information with sibling regulators in other states or other countries. But privacy concerns prevent anything more than the very general trends. And the federated learning, as I understand it, is an attempt to use access to encrypted data sets and to train neural networks across regulatory boundaries or even national boundaries, and is a potential solution to this. And so my question is this viewed as something that's really ready for prime time? Are there examples of real-world implementation of federated learning between different regulators? Or is this still something that's at the talking stage?
Thank you for the question, Chairman Foster. So we are participating with other regulatory bodies and looking at for example, the Digital Regulation Cooperation Forum, which is the DRCF, to share learning and approaches on this. We're also looking at AML through the course of tech sprints, and we're focused on building solutions and sharing common approaches.
All right. Are there any examples that any of our witnesses are aware of where that's being looked at in detail in the U.S.? Going once, going twice. Okay. So I think that's a very promising area, which, if it works technically, is going to really solve a lot of the political problems with data sharing across national boundaries. There was also a discussion, Ms. Rusu, of some of the struggles with determining ultimate beneficial ownership and how that works. At the heart of that is the issue of having a secure digital ID for market participants that works across national boundaries. During all of the discussions in your tech sprints and so on, are there any discussion of what amounts to a crypto driver's license, or something that would allow participants to anonymously identify themselves in a way that the regulators could see but market participants could not?
So I know that some of the tech sprints have looked at privacy-enhancing techniques or PETs, as well as different types of encryption like homomorphic encryption. And I think, and certainly there's a lot of work to be done in that area. I think we have some more focused areas coming up in tech sprints later this year to delve into some of that. And I would say that I also saw some of those solutions or issues that you referenced in terms of ownership were addressed this week in the two-day crypto sprint that we held. And so it's something that we don't have an answer to, but we're certainly investigating.
Okay. Were there any other high-level conclusions from that work?
So in terms of the crypto, I think we'll be in a position to share some of the findings later this summer.
Thank you, because the whole issue with, crypto and secure digital identity and pseudonymous but yet legally traceable access to crypto transactions is, I think, really at the heart of, at least in the U.S., I think it's at the heart of the discussion going on right now. And at that point, I will recognize the ranking member for 5 minutes.
Thank you. Mr. Greenfield, I'm going to start with you. I've heard from advocates for greater use of emerging technology in the regulatory system and also from private industry that it is sometimes difficult for regulators to work with private industry on testing and acquiring new technology for pilot programs. Is this something that you have experienced in the OCC, and what ideas might you have to help solve that?
Sure. No, and this is something that here at the OCC we've looked at extensively. Again, we support responsible innovation in the banking industry, and part of having that innovation is institutions and industry's ability to develop and test new products and services. We do have supervisory guidance that helps lay out expectations for banks' engagement in new or modified products and services that talks to the importance of risk management, governance, stakeholder review as part of these processes. Our Office of Innovation is very engaged, not just with financial institutions, but many of the fintech and emerging tech companies that are helping to develop these products and services and bringing them in for one-on-one discussions or as part of office hours to discuss what it's like to operate within a banking environment, expectations around risk management and control, and to really respond to their questions and allow them to better develop the products and services that they're going to be offering to the financial institutions that we supervise.
Thank you, and I think that makes a lot of sense, and hopefully those interactions are done in a productive way. I know for a lot of emerging tech companies, there's a fear of coming to Washington and working with regulators because what you'll hear oftentimes is some of these conversations turn into a predicate for an investigation when they were really just looking to get some simple answers. So I understand the hesitancy, but the more dialogue and openness I think we can have between our technologists and our regulators, the better. That wasn't an accusation, by the way. It's just sharing observations, conversations I've had.
It's one of the reasons why we have our Office of Innovation that's separate from our supervision group, is that it is an open invitation, as well as not only to come into D.C. and speak with us, but there also will be office hours in many of the tech cities around the country.
That's great. Staying with you, Mr. Greenfield, one of the more interesting applications of AI and machine learning, in my view, is the ability to crack down on illicit finance. Can you discuss how banks are currently using these technologies to better track financial crimes, and what more our regulatory agencies can be doing to promote the use of this technology?
Sure. I think this is one of the biggest areas of RegTech development that we've seen, is advances in the products and services developed both by banks as well as being offered by third-party service providers to allow for better and more efficient identification and determination on suspicious activity, and for ensuring adherence with bank secrecy and anti-money laundering laws. Banks have often been challenged with, again, going back to the fundamentals of validation and testing when it comes to ensuring not only that the model is picking up, but it's also not overreaching and having a lot of false positives, and really being able to adjust those models over time. And it is something that banks continue to have challenges, but we're seeing a lot of advancement in this area, and there is a lot of opportunity because many of our other panelists here today have commented anti-money laundering laws are there for a reason, and they are very important, and it's important for adherence, but they can be challenging and burdensome, especially for smaller community banks. And use of these technologies can help provide the opportunity that we enforce these laws and enforce them as they're intended, but also reduce the burden.
Thank you. That's all I have. I yield back.
Thank you, and that will conclude our second round of questions. So I'd like to thank the witnesses for their testimony today, and without objection, all members will have 5 legislative days with which to submit additional written questions for the witnesses to the chair, which will be forwarded to the witnesses for their response. I ask our witnesses to please respond as promptly as you are able. Without objection, all members have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. I remind members that all written questions and materials for the record should be submitted to the email address provided to your offices. And this hearing is adjourned.
That one needs to be. Say it again.